Imagine you invest just $1,000 correctly and you start receiving dividends within weeks. Not just once a year or even once a month, but every week. It isn't some far-fetched fantasy. It's a real opportunity in today's market, but most people don't even know it exists. Today, I will share with you not just one or two stocks, but a carefully curated portfolio of 6 dividend-paying stocks designed to pay you every week. So, without further ado, let's get started. First, let's discuss investing $1,000 and earning dividend income almost every week. Dividend-paying stocks are companies that distribute a portion of their earnings to shareholders as dividends. These dividends can be paid on various schedules, monthly, quarterly, semi-annually, or annually. Each payout schedule offers investors different opportunities to earn predictable income. Building a portfolio that does this isn't just a dream. It's doable with the right strategy. Start with monthly dividend ETFs. These are like baskets holding stocks from various sectors known for paying reliable monthly dividends. It's convenient because you get regular income without picking individual stocks yourself. But do your homework. Choose ETFs with a history of stable payouts and growth. Look for low fees and a focus on established companies. Now for an even more frequent income flow, try the staggered approach. Mix monthly and quarterly dividend-paying assets strategically. Allocate about 60% to a reliable monthly dividend ETF for a solid income base. Then, put around 20% into a high-yield monthly dividend ETF for potentially higher payouts. But remember, higher rewards often come with higher risks. Finally, the remaining 20% should be invested in individual stocks with a strong track record of quarterly dividends like Johnson & Johnson, J&J, or Walmart, WMT. These companies have a history of increasing dividends over time, providing stability and growth potential. But how do you get paid every week? Here's how it works. You pick stocks that pay dividends at different times throughout the year. For instance, Walmart pays in January, April, June, and September, while Gladstone Group issues payouts in February, May, August, and November. Johnson & Johnson follows with dividends in March, June, September, and December. What's interesting is the timing within each quarter. Walmart pays early in the quarter, Blackstone pays in the middle, and Johnson & Johnson typically pays toward the end. This staggered schedule means you can plan to receive dividend income regularly throughout the year, smoothing out your cash flow and reducing reliance on just one payment cycle. By combining these stocks into a diversified portfolio, you create a steady stream of income. It's like scheduling paychecks. You know when money is coming in, which can help you plan your finances more effectively. This approach provides income and helps mitigate the impact of market fluctuations. Even if one stock's price is down, you still receive dividends from others, balancing your investment returns. Turning your $1,000 into a near-weekly income stream requires a strategic allocation across different dividend-paying assets. Let's explore some of the best dividend stocks you can add to your portfolio. Number 6. Cisco Systems, Inc. Cisco Systems, Inc. is all about making and selling networking using Internet Protocol, IP. It designs and manufactures products that help with communication and IT services. It operates in different parts of the world, such as the Americas, Europe, the Middle East, Africa, Asia Pacific, Japan, and China. Their products cover a variety of categories, such as secure networks, agile networks, future-ready internet, collaboration tools, security for everything, smoother application experiences, and other bits and bobs. Cisco, founded in 1984 by Sandra Lerner and Leonard Bosack, is based in San Jose, California. It's a big player in the market with a market cap of around $183.39 billion. Cisco has about 4.03 billion shares out there, and most of these, about 4.02 billion, are available for trading on the stock exchange. Cisco is known for being at the forefront of networking technology, always pushing the envelope with new ideas to make networks more secure, faster, and just better overall. Their products are used by companies and organizations worldwide to keep everything connected and running smoothly. Number 5. Lincoln National Corporation, LNC. Lincoln National Corporation offers a compelling 6.6% yield. Unlike high-flying pandemic growth stocks, Lincoln National operates in insurance, a steady but not explosive sector. The real hit came from the Federal Reserve's aggressive rate hikes, the fastest in 40 years. Lincoln gathers billions in premiums and retirement fees and invests these funds in ultra-safe bonds to meet future claims and withdrawals. However, rising rates have slammed bond values over the past 2 years, akin to the banking sector's woes last spring. Lincoln's asset value shrank despite having no deposit risks like banks, which dragged its stocks down. But there's a silver lining. With the Fed poised to reverse course and cut rates later this year, Lincoln's shares have stabilized since March 2023, offering a rare chance to buy this dividend payer at its lowest point in 3 decades. The company has maintained its dividend payout, going ex-dividend around January, April, July, and October each year. Over the past 5 years, Lincoln has boosted its dividend at a 4% annual pace, supported by robust cash flow. As the Fed eases rates, Lincoln's bond portfolio value and its stock price should rise gradually. This won't happen overnight, but investors can enjoy a solid 6% plus dividend yield and potential stock gains in this stable, well-managed company. Lincoln National Corporation presents a compelling opportunity for those seeking safety and a steady income stream amidst today's market ups and downs. Number 4. Main Street Capital. Main Street Capital, ticker symbol MAIN, is one of the best monthly dividend stocks for several compelling reasons. While it might not offer the highest yield, its solid 6.5% dividend has been consistent with no cuts over the last 3 years. This reliability is rare among high-yield monthly dividend payers. Main Street Capital operates as a business development corporation, BDC, specializing in providing loans and equity investments to mid-sized businesses. It holds 182 portfolio investments, with the largest representing just 3% of its fair value. This diversification minimizes the impact of any potential setbacks in individual investments on its overall performance. One crucial factor to consider with BDC stocks, like Main Street Capital, is comparing the average yield on investments and dividend yield. Main Street Capital earns a weighted average yield of 12.6% on its loan investments, significantly higher than the 7% it pays out in weekly dividends. This surplus average yield above its committed dividend yield is essential for sustaining its dividend payments over the long term. Number 3. Gladstone Investment Corporation. Next up is Gladstone Investment Corporation, offering a solid 6.9% dividend yield with its monthly payouts. Like Main Street Capital, Gladstone is a business development corporation, BDC, specializing in lending to small and mid-sized businesses that fall between bank loan qualifications and stock exchange listings. What sets Gladstone apart is its strategy of taking a higher equity stake in the companies it invests in than traditional BDCs. While most BDCs focus on a mix of lending and equity with less than 10% equity ownership, Gladstone targets a higher 25% equity share. This approach provides bond-like cash flow and safety and enhances potential upside returns from equity investments. Despite the higher equity exposure, Gladstone has a strong track record of return on equity, ROE, averaging 17.7% over the past 5 years, more than 3 times the median ROE of its BDC peers. Although recent returns have moderated slightly, they remain well above industry averages. Gladstone's portfolio is well diversified across 28 companies spanning 14 different industries. This diversification is crucial as it mitigates risks associated with economic downturns, potentially maintaining stable returns across various market conditions. Investors looking for consistent monthly dividends and exposure to a well-managed BDC with a history of strong equity returns would find Gladstone Investment Corporation appealing. While the higher equity ownership strategy potentially carries more risk, it positions Gladstone to capitalize on growth opportunities and deliver robust returns over the long term. Number 2. Altria Group. Let's talk about Altria Group, ticker MO, and its juicy dividend yield of almost 10%. I get it. Altria's business isn't without its controversies. Especially if you're not into tobacco-related stocks, But if you're eyeing that second week of June, September, and December for dividends, Altria fits right in. You can almost balance it out with other stocks from this list that pay out around the same time. Despite declining traditional cigarette sales, Altria has been smart about adapting. They've been diving into the smoke-free products market, where there's still a growing demand for nicotine, ticking up about 1% each year. Plus, Altria managed to hold on to and even grow its market share against its rivals. What's appealing about Altria, though, is its fat dividend yield. It's almost 10%, which is hard to ignore if you're looking for regular income. Right now, the stock's trading at a bargain, only 8 times its earnings. That could make it a solid buy for investors who like the idea of high dividends and a decent valuation. So, despite the controversies and the shifting market dynamics, Altria Group stands out for its hefty dividends and strategic moves into new markets. If you're okay with the tobacco angle and looking for solid income potential, Altria could be worth considering for your portfolio. Number 1. Walmart. Walmart Inc. is a retail powerhouse that's not just a local store anymore. Walmart operates all over the globe, from the US to places like Africa, Canada, Chile, China, India, and Mexico. You name it, they're probably there. Now let's crunch some numbers. Walmart is a big deal in retail, with a market value of over $536 billion. That's a lot of money. They've got 8.04 billion shares in the market, which shows how many people are invested in them. If you're into dividends, basically getting paid for owning stocks, Walmart pays 83 cents per share yearly. That works out to about 1.24% return on your investment. It might not be the highest payout out there, but it's steady and reliable, which investors like. In terms of money coming in, Walmart has raked in about $657.332 billion in the past year alone. That's massive sales, showing just how many people shop there worldwide. Their profit margins, the money they make after all costs, are pretty decent too. They've got a gross margin of about 24.5%, which is how much money they keep from each sale after paying for the stuff they sell. Their net margin, which is the profit they keep after all expenses, is around 2.99%. For several reasons, adding Walmart to your investment portfolio can be a smart move. First, Walmart is a massive player in the retail industry with a market value of billions of dollars. That size and stability provide a strong foundation for any portfolio. It's a well-established company with a global presence, operating in the US and across several continents. Moreover, Walmart is continuously evolving its business model. The company heavily invests in e-commerce and omni-channel initiatives, aiming to compete effectively in the digital age. This strategic focus on technology and innovation ensures that Walmart remains relevant and competitive in the retail landscape. Additionally, Walmart's diversified operations across its Walmart US, Walmart International, and Sam's Club segments provide stability. This diversification spreads the company's risk across various markets and segments, reducing the impact of localized economic challenges or industry-specific issues. For long-term investors, Walmart's size, financial stability, dividend consistency, and strategic investments in digital transformation make it a compelling addition to a diversified portfolio. It offers a balance of growth potential and income generation, making it suitable for growth-oriented and income-focused investors. Adding Walmart stock to your portfolio can provide exposure to a resilient and globally recognized company with a history of delivering shareholder value through dividends and capital appreciation. So, while wrapping up, we can say that the key advantage of dividend-paying stocks is their reliability. Unlike relying solely on capital gains from stock price appreciation, dividends offer tangible returns less dependent on market fluctuations. Even if stock prices fluctuate, dividends provide a steady income that can help stabilize your overall investment returns. Moreover, dividend-paying stocks are often associated with stable, mature companies with a profitable history. These companies typically have strong cash flows and a commitment to returning value to shareholders through dividends, making them attractive to investors seeking income and long-term stability in their investment portfolios. Now, are you ready to start your $1,000 portfolio and reap weekly rewards? Share your strategy with us in the comment section below, and don't forget to subscribe. See you in the next video.